how do you create that recession-resistant portfolio so your portfolio doesn't blow up when the markets blow up?
And I like to think of what we're about to do is kind of peel back the layers. It's good, you make these investment decisions, maybe in a 401k, you set them up, but you don't necessarily know what's underneath, the curtain. I'm thinking the Wizard of Oz scenario here. So Loren is going to peel back the curtain and show us.
Yeah, because a lot of people on the couch might be thinking, what do you mean? I have control over my investment performance? I just put my money in the 401k plan, I invest in one of these default target date funds, and it just does what it does. What kind of control do I really have? That's what we want to talk about, is what can you do from a target date fund standpoint underneath your 401k plan? Why do you feel like you may not have as much control as you have? Because you're investing in most 401k plans, the target date funds are the default investment option, and your employer probably really encourages you to use these. There's a lot of benefits to them. One of the disadvantages is you may not be as diversified as what you really think. So let's look at how this target date fund really works. This is a real fund. We just stripped away the company's name because the company's name is not important. There's a lot of companies that build these, and they all work relatively in a very similar fashion. But you're invested in this target date fund. It's going to automatically get more conservative as we approach the year 2030. Inherently, that is a very good thing. But what are you really invested in? Peel back the first layer. Underneath that target date 2030 wrapper is 4 different mutual funds with this particular fund. Some target date funds will have 20, maybe 25 different funds. This one has 4. So you're actually not invested in one fund, you're invested in 4 different mutual funds. International bond, domestic bond, we got domestic stock, and international stock funds. So you're feeling even better because it's not one fund, it's 4 funds. And then you keep peeling the layers, and you find out you're actually invested in 9 different sectors. So 9 different sectors, you're feeling really good now, except for we go through a year like 2022, where the NASDAQ was down 34%, the S&P 500 is down 20%, and 8 of the 9 sectors lost money. And you're looking at your 401k plan, the balance of your 401k plan also went down. And this goes back to what we were talking about is, do you feel like you have control over your investment experience? Because there's not much that you could do about that. And that's where the diversification really comes into play, which we don't have as much diversification exposure to the 401k plan as what we do with some other investment options.
I think I know where we're going with this, because you are going to come in and peel back the layers even more and show people an option, something you can do at 59.5 that gives you even more control.
Yeah, we know most people save most of their retirement money into these 401k plans. There's a lot of good components to these 401k plans, but what you want to be aware of is at what stage of life do you potentially have more control or more access to these retirement balances. What's most common is age 59.5. That's the point in time where with most 401k plans, you have an opportunity to get control of that balance and take it out to an IRA. Some other plans may be 60, 62, 65, or anywhere in there with a separation of service.
Yeah, through the in-service rollover.
Yeah, you have an opportunity to be able to make that decision. And what that provides to us, what that provides to you is control. We know we still want to go out there and achieve the same goals of diversification as we invest and design your overall portfolio. We still want to have allocations across the different sectors and asset classes. But that opportunity now with more control, taking your retirement balances out to an IRA, now there's more things you can do. You have this entire world of investments to select from. So we're going to look at some of these. We're seeing some commodities up here. We're seeing some alternatives. Those are 2 of the asset classes that we may want to have part of your portfolio in. And this is showing 2022 performance for a handful of commodities and alternative investments. You can see that various commodities had a really strong year, like lithium. In a down market, which was 2022, lithium performed very well. There's a handful of other commodities that also had positive years. Now, don't get me wrong, there's also a handful of commodities that did perform negatively, just like the overall markets. Same thing can be said for alternatives. You see a couple of real estate, farmland that had positive returns, and then an option like private equity, a very negative return, which reflected more of the overall markets. But as you go out to this IRA, you can be more custom. You can identify the specific investment options that you want to pick from that fit your overall plan, that align with your risk appetite, where you're at in life, and fit, again, that customized retirement plan that you have. We still strive to have that diversification. You think about the 401k that Loren talked about. If we look at this pie graph, the 401k would be all in this blue color, which is those traditional sectors. You pick that single investment option like the 2030 target date fund. You think you have that diversification, which maybe you do, but is it the right fit for you? Somebody's managing that 2030 target date fund for the masses, the several million or even billions of dollars in that fund. They're not looking at your custom plan. So now you can achieve this diversification that best fits you. We still want to use some of these traditional sectors, but now we want to identify where is it the best fit to fit in some alternatives within your overall portfolio. Where does it make sense, and what are the right types of commodities to fit into your overall portfolio? It's about control, it's about customization. Let's be positioned to be in the best spot to achieve all of your retirement goals and not let your retirement plan blow up when the markets do whatever they're going to do.
Yeah, everybody knows that you can't have all of your eggs in one basket, and that just means you need to be diversified. But there's so many different ways that one can diversify today than what we've ever been able to before. Before, you used to have to be a hedge fund manager, participate in a hedge fund, or some of these types of investment options that the retail, just the average investor, didn't have access to. But now, with technology and the way that this investment world has really evolved over the last couple decades, just about anybody has access to those types of alternatives and commodities, just extra ways to insulate themselves from the downward movement of the traditional sectors that involve bonds and stocks. So it's just, the IRA offers a lot more benefits from a diversifying standpoint than what the traditional 401k offers.
And go ahead,
Well, I was
Chawn.
going to say, it's common that we'll talk with these families and we'll say, well, if you don't invest in mutual funds, then what do you invest in?
Right.
And that's where, again, it's looking at this entire market, this world. And I think you mentioned too a little bit, it's nice when we can get more diversification, we have more control, more options. And then when we do have a certain sector that maybe performs poorly, that diversification can help offset some of that. You know, we're trying to make decisions for the overall portfolio to make sure that we don't have too much exposure on the downside.
Thank you for watching this clip of Retiring Today, and don't forget to subscribe. If you have questions about your retirement plan, take advantage of the complimentary 15-minute retirement checkup phone call.